think this is telling us that monetary policy is acting with a lag, but it's also acting in a relatively straightforward and predictable manner and slowing home price appreciation and weakening home prices. And we think this is one of several headwinds to the UK economy. So, I think we continue to be below consensus in our forecast for UK growth this year. I think this weakness in home prices is a part of a global trend. We're also seeing the previously resilient US housing market also now seeing weakness as interest rates have risen. And these are some large interest rate rises. These are some of the largest rises in mortgage rates that the UK consumer or the US consumer has seen in the last 30 years, over the last 12 months, and it is going to have an effect.
Andrew, I mean, in terms of how recessions play out on the back of raising interest rates, this would appear to be to type. Housing traditionally always seems to be one of the first asset classes to be impacted here. What do you think that tells us about the prospects of the other pieces of the jigsaw puzzle falling into place then? And ultimately, we are in recession by the middle of the year, not only in Europe, but in the US.
Yeah, so I think it's not surprised that the market has a short attention span. It wants everything immediately. And I think we've seen that year to date, where the market has gone from being very downbeat about growth to being more optimistic on the back of a strong US payroll number and a strong retail sales number. But I think this is still an open case. I think there's still a lot of uncertainty here, and I think we're still seeing a pattern of the data where a number of the more leading series, I'm glad you mentioned housing there. I think indicators like PMI, which we'll get today, those indicators do tend to be more leading in the economic cycle, and parts of the economic data that have showed more strength, things like payrolls or wages, historically, those have been more lagging and been some of the last things to show weakness. So, I do think, the data has been a little bit better than we expected year to date, but I think there's still a lot of uncertainty out there. And at the core of our thinking is either way, growth is very likely going to slow, both in the US and in Europe between now and the end of the year. And that slowing is still going to create some pressure for earnings and still create some downside risk to stocks, especially in the US.
And yet we are still significantly higher, good morning to you, Andrew, significantly higher than our autumn lows on US indices, even though it's been a soggy month in February as well. Are we likely to revisit those lows?
We still think that there's a reasonable risk that we do. I mean, our year-end target for the S&P 500 is 3,900, so we don't think we end the year at those lows. But I think markets are still facing, especially in the US, I think a very difficult alignment of leading economic indicators that are still pointing to growth deceleration, an earnings picture that we think is somewhat weaker than the market appreciates. We don't think the fourth quarter earnings season was particularly strong. We're seeing forward earnings estimates turn down, which is rare, but when it does happen, it tends to be more challenging. And then we've seen higher interest rates than we were expecting. And so we've been raising our forecast path for the Fed, raising our forecast path for the ECB. And that's an additional valuation pressure, as if investors can get over 5% on Treasury bills, I think it naturally has to raise the implied return that one demands to own much riskier equities. So I think all of these things still mean that some of those downside risks to markets are still in play. We do think that March is a pretty critical month from that. Seasonality tends to be somewhat weaker. We're at some key technical levels, but we still think that more caution here is warranted over the short term.